As we all know, the outbreak of COVID-19 has caused a widespread concern and economic hardship across the globe. During our live webinar today, there will be discussions on steps to take towards coping with the current situation in the banking industry. Our experts today will be presenting their in-depth knowledge and expertise. Before we proceed, I would like to welcome Dr. Ahmed Al-Hadi, Assistant Professor, Postgraduate Studies and Research Department from CBFS, to give few words. Dr. Ahmed?
Is being recorded by joining the argument.
We'll watch from the same laptop or what?
I think it's better, but we are trying still, we cannot.
Okay, we can all listen to
Yeah.
here, yeah?
Yeah,
Let me bring my coffee.
Okay.
I think Bismillah ar-Rahman ar-Rahim. Do you hear me?
It's audible, please.
Yes.
Loud and clear, loud and clear.
Yeah. Bismillah ar-Rahman ar-Rahim. Thank you, Ms. Moderator, and I would like also to thank all the speakers and the guests and CBFS and Banking Association to join together today with us. It's really a very interesting topic that we come up today. CBF Postgraduate and Research Studies, actually they have similar initiative around during the COVID. And most recently, actually, we have recently received grant from TRC regarding COVID. The topic was the response of monetary and fiscal policy and fund performance during COVID. And this is not just an interesting topic. Actually, I believe this topic today can be a paper published by CBFS in future, inshallah. We as a department, really, we even developing different seminars and webinars during the pandemic. And most recently, even how to publish during the pandemic. And I think the guest speakers today will introduce us really very industry expertise.
Dr. Ahmed, we cannot hear you.
Do you hear me now?
Yeah.
Yes, we can. Please go on.
Now, what we also observe during the pandemic, we observe there's 7 types of banking or central bank circular around the world regarding the fintech during the pandemic. These are including electronic payments, e-wallet encouragement, reducing cashless, mobile transaction encouragement, and also they include fees transfer reduction during the pandemic. So fintech also one of the core future businesses for banks. And during pandemic or COVID pandemic, we think fintech will develop and emerge strongly in banking industry. Today, with our guest speakers, this might be also a great topic we can discuss. Therefore, I will invite all guests to encourage themselves in questioning and then also a research-based orientation as a CBFS guest. Also, we would like academics to think carefully about industry bank during pandemic. And that's all. And I wish all guest speakers and the guests to enjoy themselves during the webinars. And that's it. Thank you very much.
Thank you very much, Dr. Ahmed. And now I would like to welcome Ms. Carla Slim. Ms. Carla is an economist in Standard Chartered Bank based in Dubai. Ms. Carla provides on-the-ground analysis of microeconomic and financial developments in MENA to external and internal stakeholders of Standard Chartered Bank. Ms. Carla?
Thank you very much, Marwa, for the introduction. And I'd like to extend a thanks to the entire OBA for the invitation today. It's really a great pleasure for us to be here with you all to discuss the global economic impact of the pandemic, but also the regional economic impact and how it pertains and how it's panning out in Oman now and in the near future. So I'm going to start by sharing with you all my screen so that we can see the presentation. This way we can all be on the same page with regards to the talk. So my presentation today will be relatively short. I'm going to spend around 5 minutes just discussing a global snapshot of where we see the global economy today, taking into the impact of COVID. Then we will discuss a little bit some views, some color on oil prices, because this is definitely one of the key factors that have resulted from the COVID pandemic, which definitely impacts through several channels our regional economies, so that we can then also touch a little bit on Oman and discuss some of our views there. So with regards to the global economy, really it's very, very difficult to understate and underestimate the impact that the COVID-19 has had on the global economy. I'm sure many of you, all of you on the call, have heard from different economists, different multilateral organizations such as the IMF, discuss the severity and the impact of the recessions that have emanated from this global crisis, which has turned from a health crisis into really a financial crisis. And really, this is a crisis that is so shared all over the world that we don't really need to elaborate on it so much, because every one of us in our different markets has experienced it through different shapes or forms of lockdowns to various degrees, or just the economy is coming to a standstill to various degrees. So I won't spend too much time in describing the severity of the shock to the global economy. The only thing I would say is that in terms of numbers, this is definitely the worst peacetime performance we have seen for the global economy since World War II.
Doctor, Miss Carla, can you please unmute? Unmute, please. Can you please unmute? Can you please unmute?
Miss Carla, you're muted. Miss Carla, we can't hear you.
Can you hear me now?
Yes, we can perfectly.
Okay, sorry, I'm not too sure why it's
That's all right.
sharing my screen. Do let me know if this happens again. Okay, so the slide I'm sharing right now describes basically our forecast for the world economy. So as I was saying, we're expecting a global contraction of -3.3% in 2020, and this is the worst peacetime performance that we have seen since World War II. And this slide is really interesting because it shows you our forecasts before the COVID shock. So before the COVID shock, we were actually expecting the world economy to grow by 3.3%. And if you remember last year, we were already discussing US-China trade tensions, and there were already looming risks to the global economy that was really concerning a lot of companies, a lot of corporates, a lot of financial institutions, including banks, and really most market players were discussing risks to the global economy, even when our forecasts were at positive 3.3%. Since the impact of COVID-19, and since we have revised all of our growth forecasts really for all of the countries that you see here listed that we cover globally, the difference, which is the far right column over here, is actually 6.6%. So the delta, the difference between our expectations for the global economy before COVID at the end of last year, and now having taken into consideration all the lockdowns and all of the different factors for different markets, the impact, the magnitude of the shock, which we have quantified so far, is -6.6%. And it does seem that the deepest forecast cuts we have made are for Europe and the Americas. And that does mirror the on-the-ground evolving situation of COVID, especially in these two markets. Now, in terms of policy response, and we heard also in the opening remarks that the policy response have been something that market players all over the world, individuals, companies, banks have really been watching out for, because it does impact us sometimes even on our in our individual daily lives. And in that sense, we've seen policy responses range from monetary policy with regards to lower interest rates, global interest rates, which have also trickled through from developed markets to emerging markets, to fiscal intervention by governments, which sometimes have gone as far as really putting money in people's pockets. And that's why I mentioned that these responses to the global shock of COVID can even impact us on an individual basis in some markets. So all of these policy responses are still something that we are watching for. We don't think it's the end of the government and the central bank support response for the shock. We think that this is a shock that's going to have enduring implications for the global economy in various markets to various degrees. And we are not expecting, in terms of the shape of the recovery, we're not expecting the recovery to be very rapid. We actually, there's a lot of debate globally between whether this is a recovery that will look like a V-shaped recovery, or an L, or even some have suggested the check sign, the Nike sign, the Nike swoosh. Where we stand currently, obviously there's a lot of uncertainty around the prospect of a second wave. Many healthcare experts around the world are already including in their normal scenario and their base case assumption that there will be indeed a second wave of infections that is sharper and steeper than the first wave in October. So there's a lot of uncertainty whether to include this in the base case scenario or not. Where we stand today is that what we can say with most degree of confidence is that we are not expecting a V-shaped recovery for the global economy. We think that a V-shape is not currently possible at this current stage with the level of uncertainty. And we actually think that the global economy will need to first experience a recovery for a couple of years before it goes back to the 2019 base level. So we will likely not see the economies go back to the 2019 level by end 2020. We will likely have to wait till maybe mid or end 2021 for the global economy to go back to the base with no growth. This is just to go back to the 2019 base level. So that's on the global economy snapshot, and that really helps us now frame the discussion on oil prices, which have been really an indicator that we have been following as an indicator that also reflects the health of the global economy. And we will discuss oil prices before we move on to the Middle East discussion as well, because as we know, the impact of the shock on the Middle East has been driven by the shock in oil prices, not just the COVID crisis. And the recovery as well will be driven by, will take into consideration, or the oil prices will be a very big factor in determining the shape of the recovery for the Middle East. So in terms of our oil views, our views on oil prices, definitely the COVID shock that we've seen has been a shock on both demand and supply. But the trend that we're seeing right now is that the shock to supply, which caused WTI contracts to go into negative territory back in March, April, that sort of shock we seem to have emerged from. And that crisis, the supply crisis that caused technical prices or technical negative prices, we seem to have overcome this challenge. And it seems that the issues that were there on the supply side have been addressed, also helped by the OPEC commitment to cut production and to keep a lid basically on how much oil is being traded globally. But now the risk we actually see is to demand, and this pertains to my previous comments on the global economy, the fact that there is still so much uncertainty with regards to how long the health crisis is going to last. And obviously we're not health experts, but we do realize that the level of uncertainty surrounding the health crisis does not allow us to get too complacent on oil prices. And we actually feel that oil prices may have gone a little bit too high, a little bit too fast at the current juncture. And we do believe that there is significant downside risk to the level of oil prices, at least where they stand today. And we are looking for some correction in oil prices due to these risks to demand. So just to give a final note on our oil price forecasts, this way we can discuss the regional economies with these numbers as anchors. We are expecting Brent prices, and Brent is really the metric that matters for the Middle East. WTI is more relevant for the US, but Brent is more relevant for our regional markets. So we're forecasting Brent prices to average $35 per barrel in 2020, and then gradually rising to 44 in 2021 and 55 by 2022. So the point is that we're likely not going back to oil prices of $80 or $90 anytime in the next few years in the foreseeable future. And that's what I wanted to basically end the oil price thoughts with, so that we can discuss the regional economies in the context of these oil price forecasts. So now moving on to our region. Basically, I'd like to start by saying that the Middle East region, and the Middle East region as we define it is MENAP and Turkey. So the Middle East, North Africa, Pakistan, and Turkey. We cover 12 countries in this region, obviously the 6 Gulf countries. And over above the 6 Gulf countries, we also look at Egypt, Jordan, Pakistan, Turkey, Lebanon, and Iraq. These are the 12 MENAP countries for us. And we've noticed that even before the COVID shock, even before the drop in oil prices that was driven by the COVID shock, the Middle East region was underperforming the global average even before the COVID health crisis. And this is due to the 2014 oil price shock, whereby it has caused a deceleration in economic activity, not necessarily a recession. So what we're seeing today in the GCC and in the Middle East are recessions. They're negative rates of growth. The 2014 oil price shock caused a deceleration, so slower levels of economic activity, not negative negative growth in various markets. And the Middle East had still not recovered from the 2014 oil price shock, even before the COVID crisis. So this is especially important to stress, that we are not starting from a very high base, such as other markets in the world, whereby China was growing between 6.5, around 6.5%. Even the US had much higher levels of growth than we had. So the entire Middle East region, both the oil exporters and the oil importers, because as we see, there's a very high correlation in our region between oil prices and even the oil importers, which sometimes is counterintuitive. One would think that when oil prices are low, the oil importers benefit from these low oil prices in terms of their dollar funding needs. But on the contrary, we actually see that when oil prices are low, the entire Middle East bloc, both oil exporting countries and oil importing countries, tend to suffer by a similar magnitude. So our region was still underperforming the global average before the COVID crisis. It had still not recovered from the 2014 oil price drop, and it is now facing the sum of two crises. It is now facing the global health crisis, which everyone is facing, in addition to the oil price shock, which was in itself a crisis that the region went through back in 2014. So I really want to stress on this idea of the sum of two crises, because when we talk about the policy response, whether from governments or whether from central banks, it's really important to keep this idea in mind when we look at the response. So the response in our region has been twofold, similar to the rest of the world. We've seen a central bank component and we've seen a government fiscal component. The central bank component is basically the drop in interest rates, which has been a global phenomenon. It obviously in the GCC, with central banks having, most central banks having fixed exchange rate regimes to the dollar. So we have a fixed exchange rate to the dollar. We import monetary policy from the US. At times, the US has a different business cycle than the GCC. So what works in terms of monetary policy for the US doesn't necessarily work for the GCC. But in this specific instance, given that this is a global health crisis and it has affected pretty much all global economies along the same lines, in this specific instance, the drop in interest rates, which we imported from the US Federal Reserve, was very much appropriate as a response. And we've seen the central banks, including the Central Bank of Oman, lowered their policy rates in response to lower rates in the US. So that was the first part of the response. The second part of the response sometimes gets muddled. There are blurred lines here between fiscal policy and monetary policy when it comes to the support packages that have been announced by the central banks around the GCC. So I'd like to highlight here that we do not view this as per our research team, we do not view this as direct fiscal stimulus. We are calling these central bank support packages because we view them as liquidity support packages in order for what started as a health crisis not to turn into a financial crisis. But we do not view these support packages, which amount to around $200 billion, which is around 11% of the GCC's GDP. We do not view this $200 billion as direct fiscal stimulus. And I'll explain why. The reason why we don't see this as direct fiscal stimulus is because if we look at the impact that lower oil prices have had on budgets of the GCC, there is simply no space for this stimulus to have been put on the budgets of the GCC economies. And the reason I say that is because before the COVID crisis, we were expecting GCC budget deficits to amount to around $75 billion in 2020. And it was sort of a similar level to what we had seen in 2019, just maybe a little bit of an increase because we were expecting some countries, namely Saudi Arabia, to boost spending, government spending a little bit to boost economic activity. Unfortunately, with the drop in oil prices, that number, so the base we started with, which was $75 billion last year, we now expect $175 billion to be the number for the total GCC fiscal deficits, the total GCC budget deficits for 2020. So the drop in oil prices has caused an increase in budget deficits across the GCC bloc by $100 billion. And this is without taking into account that these packages, the $200 billion of support packages, this is not by putting them on the budget. This is just by considering that there are central bank allocations earmarked from the central bank to support liquidity. Now, all of this is also happening in the context of dollar pegs, particularly in the GCC. And here I would like to draw your attention to the chart on the left-hand side. This is a chart on the GCC financial buffers, comparing 2020 to 2014. Now, this basically tries to show the reserve coverage ratio, or how much reserves the GCC central banks and the sovereign wealth funds have to be able to sustain their fixed exchange rate regimes, the dollar pegs. And we do see that there has been a deterioration between 2014 and 2020. In some instances, if you look at Saudi Arabia, for example, if you look at Oman, if you look at Bahrain, there has been some deterioration in this reserve coverage ratio because of two things. FX reserves at the central banks have weakened in the past 6 years because we have had budget deficits for the past 6 years, which have had to be financed both by domestic debt issuance, but also external debt issuance through Eurobonds, and also tapping of savings, sovereign savings, whether it's with the central bank's FX reserves or the sovereign wealth fund assets, which means that the pool of savings that the GCC has shrunk since 2014 because of lower oil prices since also 2014. Now, there's been a lot of talk about whether various central banks in the GCC are going to be able to sustain their pegs in the current environment, given everything we've said so far. Our view as Standard Chartered Research is that the GCC as a block still has $2.5 trillion worth of assets. So if we sum up the sovereign wealth fund assets and the FX reserves of all the central banks, the 6 central banks, and all the sovereign wealth funds, we arrive at a number of $2.5 trillion worth of sovereign savings at the GCC level. So this underpins our view that we do not expect any exchange rate to diverge from the dollar peg. The dollar peg, we don't expect a depeg situation in any of these countries, assuming some level of transferability to some of the countries which have a weaker reserve coverage ratio, which we are looking at right now on the graph on the left-hand side. So in this, on this note, I think it's a good time to move on to Oman specifically. I'll just spend a couple of minutes talking about Oman. I do understand that also my time is coming to an end. And if there are any questions also, we can address them towards the end of the total session. So on Oman specifically, I just want to say a few things on growth because I started this session talking about economic activity globally. Oman is really one of the countries in the GCC and in the Middle East region where we feel that potential growth is actually quite high and has not deteriorated significantly in the last few years. We would view potential growth of Oman around 5%. Which stands quite well among other peers, because we feel that there are a lot of sectors that have that the government has focused on, for a long time. Recently with the diversification plans, but even before the drop in oil prices of 2014, the last drop in oil prices, not the 2020 drop in oil prices. These are sectors that still can benefit from added capacity, which the government has really focused on continuing investing in. And at times, even though Oman's fiscal balance and its budget deficit was let to deteriorate and to really grow, the funding that has gone into infrastructure was really put in place and invested in a way that would play into Oman's strengths and Oman advantages in fostering these sectors that can really create jobs that can help with connectivity, that can help with trade and tourism and all of the sectors that Oman has chosen to focus on. And Oman's geographical position and its relationships with neighboring countries, but also global powers, has also helped it in this regard. So we think that on the policy front, when it comes to really investing in the future and potential growth, Oman is really one of the countries that we look at as an example in the region for having this broad-based investment framework and at the same time targeted towards where there isn't already a lot of capacity in. So that's a few thoughts on potential growth first. Then on the reforms. So our theme really for the region within this COVID crisis, is the only way out is through. And what we're trying to describe with the sentence is that the only way out of the crisis, both the oil price shock and the COVID crisis for the region as a whole, so not just the oil exporters, is through political and economic reform. And I think the theme of political reform has emerged as strongly as the theme as economic reform in various countries. So we know that we ended the year last year with many countries exhibiting a high level of protests, high level of unrest, whether it's Lebanon, whether it's Iraq, whether it's some news of small-scale protests in Egypt. So this theme of the only way out is through really speaks to the structural reform idea that the region really has to implement in order to unlock these levels of potential growth that we're seeking, in order to create jobs for the youth and also to cover the deficits through Eurobond issuances, because obviously Eurobond investors are also really prioritizing this structural reform in a very high manner. So in terms of liquidity, especially for Oman, we do not expect any sort of liquidity problems in 2020. We think that the current reserve position of the central bank and the sovereign wealth fund assets are more than enough to provide funding flexibility for 2020. And at the same time to underpin the dollar peg. So as you can see on the figure on the left, we are not expecting any sort of depeg event for Oman either. And what we're really expecting for Oman is that the new leadership really the world and the investors are really looking for this move towards structural reforms, which we have already seen coming through since the beginning of the year, and a continued push on these reforms, particularly when it comes to the reforms on the economic front related to the fiscal balance. So the talk on value-added tax in Oman has been there for a few years now. We have seen various sources and various proposals on linking VAT to a certain growth level. I think that's a very smart idea and very good way to go about it. But ultimately, we will have to see these non-oil raising revenue measures be implemented in order to basically unlock external funding from Eurobond investors and also continue contributing to positive liquidity trends in Oman and also financing these potential growth priorities that we've discussed. So I'm going to stop it here to not take too much time, and I'm going to pass it back to the moderators. Marwa, back to you.
Thank you very much, Ms. Carla.
My pleasure. I'm stopping to share my screen.
All right then. And now I would like to welcome Mr. Craig Bell. Mr. Bell is the Chief Financial Officer of Sohar International Bank with over 25 years of banking experience. Mr. Bell has an extensive international experience in managing complexity across dynamic and changing markets. Mr. Bell is distinguished CA member of the Institute Chartered Accountants of Australia and New Zealand. Mr. Bell?
Thank you. Thank you for the introduction. Can I please ask you to put the presentation up, and I'll ask you to page turn as we move through that.
No worries.
Thank you, Marwa. May I also start by saying many thanks to Carla. That was an excellent presentation, and it's a tremendous introduction for my first slide, where I will be talking about macro events and how we respond to those. I'll just wait for the presentation.
Mr. Bell, we can't hear you.
I'm sorry, I'm waiting for you to load the presentation.
Okay.
I'm on my mobile.
Yep. Does it appear
Excellent.
on your
Thank you very
screen?
much.
You're
That is
most welcome.
perfect. Thank you. Thank you very much. Next page, please. Excellent. Thank you. So as Carla has presented, we've talked about the macro events. I've highlighted there the oil prices, COVID-19, and how that impacts the economies, and the geopolitical was touched on also. So how do we respond to these macroeconomic events? What we heard from Carla was some words which were very important in terms of words like unprecedented, economic turmoil, uncertainty, rapid change, complexity. So how do we respond to this? Corporate governance is at the core of how we respond. The words I've used here in the presentation are very specific. It talks about the importance of enhanced corporate governance to effectively manage current and evolving. Those are important words: current risk, evolving risk, to support our customers, embrace regulatory initiatives, and optimize profitability and capital. The key risk areas of operational risk, credit, market, and liquidity is what we will discuss shortly in terms of how the banks are responding. Most importantly, this presentation focuses on the connectivity amongst and the importance of the players within the market, in particular, the government's response and Central Bank of Oman, who regulates the banking environment here in Oman. In particular, we are fortunate that the regulator has engaged with banks on a timely basis in response to the crisis, economic crisis, been proactive in their approach. They have been internationally consistent in terms of looking at policies and guidelines, and they're very much locally aware very important aspect of the regulatory involvement with the banks is being locally aware. Next page, please. Next page, please. Thank you. So credit risk and asset quality, what's been happening in terms of impacts? Well, clearly the disruptions in supply chains, domestic consumption, tourism has impacted businesses and therefore their profitability. There's an accounting standard called IFRS 9. That is a very forward-looking standard, and that very much impacts banks' profitability because it's based on default rates, expected future events, and this can very much impact banks' profitability. Rating agencies also downgrade banks. This signals potential increases in counterparty credit risk. The central bank has responded very proactively in terms of introducing deferment of loan installments to help customers, deferring interest and profit rate repayments, and also deferring risk classifications in relation to how we look at treating customers. This gives some relief from the IFRS 9 features. If we look at the actions that are required by banks, what we're seeing is very much an enhanced credit assessment practice to manage these deferments and monitor customer positions and consider what it'll look like post-deferment. We look at our counterparty credit and settlement risks also. I think what's very important to keep stressing is that we're looking at current events as well as future events. How are things going to look in the future? IFRS 9 governance is fundamental to how we look at credit risk and the impacts it will have on banks. Committees are looking very much at what we call management overlays, looking at what could happen in terms of industry-specific and client-specific events. We're looking at our macro variables, considering regulatory guidance in relation to these variables, recalibrating models, assessing significant increase in credit losses post-deferments, and looking at our disclosures. There's a lot to look at, a lot of change, a lot of volatility, a lot of uncertainty. IFRS 9 did not have this in mind, this level of extreme uncertainty. So we're in new territory. Next page, please. Liquidity and funding risk. I concur with Carla's comments regarding liquidity and funding risk. This has been very well managed. We have strong regulatory response to liquidity and funding risk as we see tightening of market liquidity, which can result in higher funding costs or even an inability to raise funds. We also potentially see impacts in terms of the ability to sell liquid assets at book value in extreme stress. And we see potential breaches of regulatory ratios and maturity gaps. The central bank has been very proactive in terms of addressing the needs of banks, in terms of reducing its repo rates and the tenor, the foreign currency swaps, by also reducing the basis points and the tenor, and discounting instruments such as government T-bills and rediscounting bills of exchange. These are very powerful tools to support the banks. So in the event of a tightening market, it means the banks do not have to start competing aggressively against each other to bid up rates. There is still bidding pressure, and every bank has a different profile. But the CBO measures very much limit and support the banks in terms of managing effectively their liquidity and funding risk. In terms of actions, close engagement with the central bank, increased activity of our liquidity and contingency planning committees. The banks will have contingency plans in place where they look and test market liquidity and pricing. They look at movements in terms of cash flows. We do additional liquidity stress testing to see what the future may hold. And importantly, we look at the liquidity contingency plan triggers and what we call early warning indicators to see the extent to which the market is becoming more stressed. A typical example would be where we see an increased drawdowns by customers of their deposits, increased drawdown of committed facilities by corporates. These are all early warning indicators and things the banks can then deal with. Next page, please. Thank you. Market risk, again, my personal view, I concur with Carla's view regarding the exchange rate. A depeg would pose potentially very significant market risk for some banks, depending on how they're positioned. Managing market risk, whether you decide there's a risk of depeg or not, foreign currency is something you would manage and consider what would happen if there was a potential depeg, and therefore you have to manage your risk accordingly. So what we're seeing in terms of market risk is we've seen loss of market confidence in some debt and equity instruments. To the extent these are held by banks, that can result in unrealized gains or losses within your P&L or in your statement of retained earnings. We see increased potential pressure on local currency, but as I say, we don't expect a depeg. And there's interest rate risk volatility, which can impact your asset pricing and your liquidity position. So what actions do we take? We look at various hedging options to the extent they're available. We look at de-risking strategies around your market risk to the extent you can deleverage. Review of our market risk models, recalibrate, stress testing. Again, what is the maximum impact you could potentially have on your bank? And then we review potentially behavioralization assumptions of how we think our deposits will behave given the stresses in the market. Next page, please. Operational risk and business continuity management. This is fundamental, and we've seen a lot of movement in this area, a lot of activity in terms of the impact of COVID-19, from having to look at our work from home staffing requirements. What does that come with? Securing connections to secure data, allowing teams to communicate remotely, looking at the risk of offices and branches closing due to infections, heightened risk of malware and fraud incidents, inability to travel cross-border impacts our ability to have external vendors support us on site. How secure is the data transfer and work that's been performed offshore? Delays in delivery of equipment and use of virtual networks and result in increase in information security risk. How do banks respond? Business continuity plans and teams. We split our teams across multiple locations. We strengthen our cybersecurity landscape and protect our sensitive data, create remote working operating models. We enhance our fraud and operation risk monitoring procedures, and we evaluate cloud technologies to enhance offshore options. 3 years ago, when I attended the IMF World Bank Conference in Washington, when they talked to the CEOs about the things that were worrying them the most, operational risk, cybersecurity was number one. That was 3 years ago. I believe a lot has been done to address these issues, but it still becomes and remains a fundamental risk, particularly during times of stress. Next page, please. Capital adequacy and profitability. Yes, profitability is likely to be impacted for banks based on the increase in expected credit losses. We see reduced business activity that can reduce fee income from a slowdown. We also see potential increases in funding costs, but those are offset to date by support from very much by central bank, but we can expect to see potential increases in funding costs. Capital ratios are potentially impacted also by obviously the profitability impacts, as well as the potential movements in your risk-weighted assets. And I'll focus on this a bit more in a moment. And clearly with profitability, with the need to retain capital, there could be stress on annual dividend payments. What are the actions? The central bank has been, again, very proactive in this area to actually support the banks, to enable them to support our customers. Lowering of capital conservation buffers, reducing the minimum capital adequacy ratio, increasing the lending ratio, and applying a prudential filter to help alleviate Tier 2 capital. These are all positive initiatives to support the banks to continue lending to support businesses who require support. The banks clearly need to be very focused on capital forecasting to include the scenario analyses, which I've talked to you about in terms of stress events, particularly including review of the underlying ICAP assumptions. The ICAP is the internal capital adequacy assessment process that all banks undergo. It's a living document. It looks at existing capital positions. It looks at the bank's forecasting of capital. But of course, with the various change that we see, this needs to be revisited constantly. We need to ensure that we have the capacity to support CBO initiatives, which is why the capital planning is so important to support the national economy and the growth of the nation. Optimizing shareholders' return on capital. This is important, and I use the word optimizing rather than maximizing return on capital. We have an obligation to continue to focus on providing an adequate return to our shareholders on capital. But optimization also means that we're not looking to maximize profitability because of the initiatives we wish to support the national agenda. Next page, please. Next page, please. Thank you. So moving close towards the summary, supporting customers and the economy, really initially by the central bank in terms of deferment of loan installments for customers, helping people who do not have employment, who have reduced salaries, and also reducing fees to our customers. Banks in Oman have embraced the CBO initiatives aimed at supporting households and businesses managed through the crisis caused by COVID-19. And as I mentioned, the central bank has been proactive in supporting banks manage the microeconomic challenges, particularly in relation to preservation of capital and access to liquidity. With challenges comes opportunity. And this was touched on earlier by Dr. Ahmed in relation to what we're seeing happening within the customer delivery, customer service, opportunities for banks to embrace the use of alternative channels for product delivery and customer experience through mobile networks, not having to visit branches. It's an opportunity for banks to change their business models. It's an opportunity to accelerate digital transformation journeys through partnerships and collaborations with fintech community. Again, a point raised by Dr. Ahmed. And finally, conscious of time, last page, please. Finally, some food for thought. Collaboration, building resilience. We've talked about COVID-19 being an unprecedented event, which has created economic turmoil, uncertainty, and it's challenging the rule books of regulators, auditors, rating agencies, economists, and banks. A collaborative approach amongst all the market participants is critical to building resilience and supporting economic growth. There's challenges in terms of each of these economic, social implications, and challenging each of the parameters around how we look at regulatory engagement, auditors, rule books, IFRS 9, rating agencies is really fundamental to the solution. Thank you very much.
Thank you very much. Thank you very much, Mr. Bell. And now I would like to welcome Mr. Mohammed Al-Hashimi. Mr. Mohammed is the head of compliance in Bank Nizwa, who is currently leading regulatory compliance, corporate governance, and anti-money laundering and counter-terrorism financing functions. Mr. Mohammed has over 11 years, including 6 years experience as an external banks examiner at the Central Bank of Oman. Mr. Mohammed.
Hello, barakatuh. Can you hear me?
Yes, we can.
Firstly, I would like just to thank Oman Banks Association and the College of Business and Finance Studies for arranging this, valuable platform just to share ideas and thoughts between us, academics, and also we have bankers, and also we have some financial experts and economists. So I'll not take much time. I'll be brief, as I have been given a slot of 20 minutes, I think, and I'll try to be brief and to the point. And just if you give me the screen control, please, Marwa.
Okay, Mr. Mohammed, you can click on the below icon, share screen. I will stop sharing mine.
Yes.
And you can control from your side. Yeah.
Can you see now? Screen?
No, not yet.
I think you can use the screen, the file given to you.
All right, sure. Let me do that. 1 second, please.
Oh, yeah.
All right.
I'll be focusing on regulatory and policy responses and measures by policy makers, international and local. And we have seen since the start of the crisis that all regulators are having the initiative to be a lead entity to make proper policies to follow and overcome the policy. I'm just trying to I'll be trying to be specific here. We have mainly 3 international bodies: International Monetary Fund, and World Bank, and Financial Action Task Force. I'll be highlighting the global update, business disruption, possible shockwave to financial systemic actions by regulators. And next slide, please. Next slide, please, Marwa. Yeah. I'll not be focusing on financial impact and the drop down in the global to local economy and sectors, as the speakers before highlighted these aspects. But I'll go brief because we have to see the reaction came from International Monetary Fund into the slum. Happened to global market, as the data shared by IMF on their website. We've seen the growth forecast in 2020 drop down to 4.9%, and they're expecting a growth in 2021, but that is not being sure yet. Uncertainties arises at the moment. If we see the advanced economies, they are severely impacted during the crisis, as -8% slump in their growth for 2020, and they have seen also they are foreseeing a growth, but in very low pace, as our colleague is Claire. She has covered that, the 2019 base will, be replicated in 2020, which I agree with. For emerging markets like GCC market, the slump was, the drop down was somehow acceptable compared to advanced economies for -3%. This is up to June 2020, and they expect that the growth will be, up to 6% in 2021, as many potentials and factors are there, like the oil price might rise up, and the current situation will be over by June 2021. Just to next slide, please. Yeah, next slide. Yeah. The IMF has covered all dimensions, and their policy responses covered many sectors, starting from healthcare to being operational and rendering fast and speed services to outsiders. And this is actually like a cycle. The cycle should be, or a chain, should be supported by local and domestic central banks into the financial system. So financial institutions are requested and they are urged to take care of the clients as well as the inside and internal operational system, ending up with the financial representation. They came with many initiatives. To mention some, temporary tax breaks for affected. So we have seen that the tax has been waived for the during the crisis on different sectors, especially SMEs. Supplying and providing services to affected customers where they have difficulties to reach banks to enjoy the services they are providing. And the operational side, where we face the split teams and work from home and having the the remote work into infrastructure, where we have to impose or pay additional efforts to have control over our lines while working from home. And as mentioned by the CFO of Sohar Bank, actually, central banks locally and internationally, they have covered almost all triangles of the dilemma we are facing now, which is the financial and non-financial. The non-financial, we are meaning here governance side, risk management, the credit, operational and liquidity side, including the market. But the market is dependent on cross-border situation as well. Ending with the business continuity within the institution itself. Next slide, please. The aid and the support was mainly for SMEs, as SMEs clients are, mainly affected. Most of SMEs at local level were closed, over 2 months. And just to support them, we have to ask financial institutions to help them and give them the support that they need by giving them the deferment, at least for 6 months, as given by the Central Bank of Oman. On March 18, actually, we witnessed Central Bank, coming with several, policy measures and responses where we have to consider both, success elements of financial sector, which is the clients, borrowers, and the financial entity itself, covering both, the financial and non-financial aspects of it. So they have to protect people by, financing the, healthcare and health sector and supportive sectors, including also the, sectors of necessities where they have to open during the crisis. Next slide, please. IMF came with financial aid and support of around 88 million in the world, which was divided in, in different sectors, going across the board to global distribution. So we have seen that, most of the, 88 million gone to Western countries, around 20 countries there. And then moving to Africa, and then to Middle East, Europe, rich countries like 7 countries of them. I don't have time just to mention them into details, and the Asian Pacific. If we move to next slide, please. And we have seen also the initiative came from World Bank. So they are working side by side with local regulators to safeguard the financial system in countries, because every system in every country is dependent on another. So, if we save one, the other one will be saved as well. The aim of World Bank to just cover at least 150 countries who are affected during the crisis, and around 1.6 billion people are also directly affected by the slowdown. If we just talk about the financial injection from World Bank was around 160 billion, I think, across all sectors and countries. Can we go to another slide, please? The World Bank has given the financial support of around 160 billion over 15 months to be repaid to address healthcare and socio-economic impact. So, there are loss of employments, and we are seeing this in our local market, where people here are losing their jobs, and they are unemployed due to the crisis. And just to give the relief to SME and mid corporates to sustain and keep their staff and employees on board by having also correlation with the financial entities and institutions, where they can give the relaxation to what's called to give them the relief of payments. Next slide, please. World Bank has strategies and approaches where they can move from one level to another until they overcome the crisis. They started with the relief, so they are facing the crisis where they have to have response on health threats and immediate social economic impact, and then the restructuring where they recovering and being ready to just overcome the crisis, and by supporting all debt resolutions and having capitalization of firms and financial institutions. Then we will have a resilient recovery where we cannot come back to the same situation, and we take advantage of the opportunity of having the crisis that has never been witnessed in the last decades since the World War. Next slide, please. The most distribution of the financial aid from World Bank Group was for different financing, and then for saving lives, like to very poor countries, moving to protect poor, having sustainable growth and jobs. So there are reasons why we are financing the world from World Bank, and also to create some policies and having impact and the slums in some emerging markets. If we go next slide, Marwa. Financial action task force. I'll go fast in this. Actually, the FATF was not silent also in this regard. In May 2020, they came with, scenarios where financial institutions will face some difficulties and threats while having the crisis on board, like fraud, cyber crimes, and misdirection of international funds and government funds. Next, please. So the threats were mentioned here. I'll go, I'll skim over them. Bypassing customer due diligence, increased misuse of online financial services, misuse or the schemes, increasing use of unregulated financial sector. So people aim to go to unregulated or entities not licensed, where they can finance in black markets and second markets. Misuse of domestic international financial aid, criminals and tourists exploiting the COVID-19 to move into new cash intensive, which is a risk in banks to receive heavy cash that is not filtered and monitored over the smart solutions possessed by banks. So in this scenario, in this case, we are facing difficulties just to monitor and pass through the cash and the monetary lines coming from abroad and international and local, where we have to pay extra efforts. Next, please. So there are recommendation from the FATF, where the financial institutions led by central banks to address and take into consideration, like having domestic coordination to assess the impact of COVID-19 on AML and CFT risk systems, strengthening communication with the private sector, encouraging the full use of risk-based approach to customer due diligence, supporting electronic and digital payment options. Next, please. This is the same as I mentioned before. The risks are faced in the region and at local sector, local level, liquidity risk, operational risk, and credit risk. Next slide, please. Actually, the crisis has affected people at all levels, entities, and individuals, where they will face difficulties just to survive. So probability of defaults has increased, and this is known to central banks and also commercial banks, where they have to expect and budget for such defaults by having proper provisions and capital buffer to absorb the losses. However, the deferments came from central bank actually helped banks to absorb some losses. So they have represented at capital level and at liquidity and at also provisioning level, where they can observe some hits from having the deferments on customers. So the cash, the liquidity is shrinking, repayment is not coming soon as expected. So we see here the deferment has come to clients, and also as well the financial institution has been supported by central bank, where they can manage having the capital buffer reduced and the liquidity to be managed within the existing deposit base, and as well as the interest rate instruments, liquidity instruments with reduced interest rate from central bank. So yeah,
time.
I'm around to just to finish. I'll skip some slides. You go next, please. So we have seen at the start of the crisis that Central Bank of Oman has injected in different forms the financial aid and support of around 8 billion in different forms regarding the liquidity instruments, ending to deferment of classification, deferment of loans and installments to affected borrowers, and reducing or stopping some existing fees, like to encourage use of electronic and cashless platforms. Some fees associated with the merchants are reduced. So the borrowers and the customers can use those platforms with full service and support. So here the merchants have got also the privilege to have reduced fees, and to move towards the cashless services, and also the interest rate by central bank through their liquidity instruments, where they helped the market to reduce the borrowing cost, plus having sufficient liquidity available in the market. So the interest rate, especially in crisis, will reduce just to have plenty of cash available in financial system. Down please. Next slide. The policy responses in numbers, the capital buffer has reduced from, by 50%, from 2.5% to 1.25%. The minimum CAR required by the CBO will eventually reduce from 13.5 to 12.25%. So banks will have ability to, grow with the existing resources. The lending ratio has been increased from 87.5 to 92.5 by using the existing deposits, where we know that the liquidity level has reduced, and there is constraints in the market just to secure liquidities. And the reduction in all interest rates, discounting, and repo has reduced just to stimulate securing funding lines from different sectors, and local and international. Down please. Yeah, next. I have covered this. Next, please. Including, in addition to the capital buffer, the calculation of IFRS 9 and the provisioning has also taken place, where we expect, and the central bank regulators all expect the default probability to increase. So some calculations have been taken into place and into consideration while representing our financials outside, and for regulators and for readers. So the deferment will not be encountered into IFRS 9 calculations, where that will post banks and will encourage banks to just give deferments, and there is no impact in their books and records over the 6 months given to SMEs and individuals and affected mid to large corporate, and also the government classification of over 12 months. And there is, incremental stages, incremental inclusion at stage 2 ECL. Stage 2 ECL is expected to rise and increase during the crisis and after the crisis due to the impact of, cash flow on clients. So back to the capital, that will be added back to the capital, where we see that 100% of the ACL will be added back to Tier 2 capital. That is in 2020, and 2021 will have 80% of the ACL, ending to 20% in 2024. So we have seen the central bank has covered all dimensions of the crisis, where they have to help the clients, financial institutions, clients, here the individual and SMEs and corporate, and they are expecting just to be vigilant for any need that market is facing. So up to here, and thank you for listening.
Thank you very much, Mr. Mohammed. So with that, we shall move ahead with the panel discussion. If I can please ask everyone again to mute themselves. And if you have any questions, you may please click on the hand icon below and your question will be taken, or you can write your question in the text box and we'll get back to you. So today's panel moderator is Mr. Ali Hassan Musa, the Chief Executive of Oman Banks Association. Mr. Ali will be discussing ways for banks to deal with current socio-economic factors. Mr. Ali?
Thank you, Marwa. Good afternoon, everyone, and many thanks to the speakers and all the attendees. MashaAllah, we have the number of attendees today in hundreds, and that's such an honor to have you all on board today. The panel, the expert panel, have covered macro conditions, micro conditions, economics of the firm, as well as regulatory support and regulatory framework. The discussions here in this session, I will start. My plan is to start with a few questions to each of the speakers, and then we can open or give the opportunities for others to ask questions. So my first question actually starts with a comment and then a question to Carla. Thank you very much, Carla, for a very interesting presentation with very detailed analysis and data. The concerns for businesses in Oman and elsewhere in the GCC has been the currency peg, and you have really covered very well the currency peg issues and the concerns. You have mentioned that the GCC have 2.5 trillion in terms of savings, though some countries are on the left side of the graph. Specifically to Oman, the currency reserves and the sovereign wealth is sufficient to cover any issues relating to the currency peg, and that's very positive. So thank you for stating that, because that is a concern for investors, for businesses, the potential growth coupled with structural reforms as well, you have mentioned. So that's excellent news. Coming to my question, it is relating to the economic sectors. What do you see in terms of different sectors? Which sectors will have faster recovery than others, and which sectors will have prolonged recovery periods? Because this is essential for government support as well as for bankers to actually deal with different sectors post the COVID era. So that is my question to you, Carla. Thank you very much.
Thank you very much for that, for both your comment and your question. On your question specifically on the sectors, I think we're really trying to guess and forecast that for most of the markets that we're present in and most of the markets that we cover. But I do believe that Oman has a slightly particular situation as well, in the sense that if we look at the different components of GDP, not by a sectoral distribution, but by an expenditure distribution, so consumption, investment, and that sort of division of GDP, the domestic consumption situation of Oman is really benefits from a large share of expatriate population, but also a large share of a local population, which is quite young and quite dynamic. So on the consumption front, we do tend to rank Oman as one of these countries that can benefit from the recovery in domestic consumption as quite rapidly. So usually we compare and contrast countries by their ability to boost GDP either by exports or by their own specific domestic consumption. And Oman benefits from that domestic consumption element. But the thing is that it also benefits from the export component. And that's where I think the advantage is for Oman, in the sense that Oman's main trade partner is China. And every year around 75 to 80% of its oil exports go to China. And despite the severe impact of COVID on China, we're actually not expecting negative growth in China this year. And the recovery is also said to be quite sharp. It will be, we expect it to be a V-shaped recovery for China. So being one of Oman's main trade partners, specifically on oil exports, and especially in the context that Oman has been cutting oil production to meet or to support the OPEC effort to shrink oil production globally, despite the fact that Oman is not an OPEC member, it has been supportive on that initiative. We believe that, at least from an expenditure perspective, the fact that domestic consumption is strong, the fact that China is set to recover in a V-shaped recovery, exports towards China will persist. And also investment coming from China into various infrastructure projects in Oman, that also will help. So compared to other countries where we feel that something has to give, it's either domestic consumption versus exports, in Oman it seems we do expect a broad-based recovery once we emerge from the crisis. That's on the expenditure side. On the sectoral side, I think that there's been a very specific effort from the government, even before 2014, before the 2014 oil price shock, to expand sectors that could be an opportunity for Oman in terms of developing and diversifying the economy away from oil. So most GCC countries have turned to tourism, have turned to trade and logistics in their bid to diversify away from oil. Some have focused on some sectors more than others. So we see efforts on the financial services side in some countries in the GCC, efforts on tourism, for example, in Dubai. So every GCC country has tried to play to its own strengths and advantages. I think Oman has had a consistent and widespread effort across these sectors, which I believe will pay off, and which I believe underpins our view of strong potential growth in Oman, because there's been a lot of investment, both domestic investment, public and private, and also external investment through FDI coming into most of these sectors, which still have capacity. So the issue we were having with sectors in the GCC before the COVID shock was that in some sectors in the GCC economies, we had excess capacity. And here we think Dubai property sector, but also some other sectors, such as retail and trade in other countries as well. We did have a little bit of overcapacity, which was leading to negative inflation in some instances. Oman does not have this issue, and that's why this investment, there's high absorptive capacity for these investments, and we believe that they will pay off with the recovery after the COVID shock.
Thank you very much, Carla, for that very interesting insight and the dimension of the trading dimension of the country, the China dimension. That's also very interesting, and the specific sectors where in the GCC where there was overcapacity. So thank you very much for that. My next question is to Greg. Greg, you have covered very well the micro effect on the banking sector. You have mentioned specifically relating to the CBO that they have been proactive with timely engagement, and that view is shared across the banking sector in Oman. I know that today we have some central bank executives with us during this webinar. How important it is now, Greg, for the central bank, the regulators, the banks, and the financial consultants, external auditors, to have an agreement, an aligned view of IFRS 9 specifics in terms of management overlay, in terms of macroeconomic definitions, and so forth. ECL computation, for example. This is a very technical, specific question, but I think we're reaching the year end very rapidly, and it is something of a concern to many bankers as well as auditors, some of which are today with us as well. Over to you, Greg.
Thank you for that question, Ali. It's a very topical question. And I think it's not just a question that would be being asked in this forum or in Oman, but also in other jurisdictions. I also think it's a very appropriate question given the last slide, which I put into the presentation very deliberately late, based on feedback from some of my senior management. And so this is very much, the example you've given is very much what I'm trying to allude to here, is that if you take IFRS 9 literally, and you look at what you probably should be doing pre-COVID, if you looked at some of your model variables, potential risk, again, potential future risk, the impacts on your models could give rise to potential future loss indicators that would be very damaging to the P&Ls of banks, and therefore capital erosion, and therefore the ability of banks to lend. Now, that is not the outcome that IFRS 9 was ever intended. It is a consequence that would arise if you were to be looking at a snapshot in time and then projecting that to a worst case scenario. So I think the importance of auditors engaging with regulators, not just domestically, but also internationally. I commend the central bank again that they've given very specific guidance in terms of how we should be looking at IFRS 9. They're consistent with international guidance. They're asking banks to look at the relief and the measures that are available with management overlays. However, they're also saying, banks, you need to look at your position. Not every bank is the same. Every bank is potentially in a different situation, maybe to a different magnitude. So I think the principles of IFRS 9 are very important, but also there needs to be some degree of flexibility in terms of how we work within the framework of IFRS 9. And I think that's where the regulator can actually assist and participate in supporting the right outcome. This is a journey. We're on a journey. We're looking to manage out of this crisis. And this won't be the first crisis of this magnitude that we face. Hopefully it is, but it may not. As with the global financial crisis, a lot was learnt. There wasn't enough regulation. So now we're in a lot better shape than we were in the global financial crisis. And you can demonstrate that through the responses of central banks, responsible central banks around the world, how they're responding. And I think this is another good example where we have to look, again, in terms of my presentation, how I looked at those variables, the management overlays, the macro variables, what do they mean? How do you recalibrate your models? What's the downside risk? What are the significant impairments we may see post-COVID? What was the situation in regards to our specific client base pre-COVID? These are all factors that need to be taken into account, and they're all dynamic. And again, disclosures. Maybe I'd like to see, personally, I'd like to see maybe some consistency in bank disclosures in terms of how banks report. So when a reader of financial statements is looking at these statements, they can reference banks and compare like with like. I think that transparency and consistency of disclosure is very important. And I think that's where there could be some, a lot more, more interaction, I think, with auditors, banks, and the regulator.
Thank you, Greg. That was an excellent answer. Transparency is what we all seek and what we all aim to achieve in the spirit of IFRS 9, as well as the flexibility under current situation. So yeah, yes, whether all stakeholders, banks, financial consultants, external auditors, regulators need to really align and talk about specifics between now and year end, so that there won't be any surprises when it comes to financial disclosure. So thank you, Greg, for that. My last question is for Mohammed. Mohammed, you covered the regulatory framework and regulatory response very well. So thank you for that excellent presentation. The Central Bank of Oman has been proactive, as you have mentioned and Greg has mentioned, have been dynamic, have been really responsive to the current crisis, helping and assisting banks through a number of measures. Those measures are not limited to the ones I'm going to mention, but include the following: installment deferrals for retail, corporates, as well as SMEs, interest waiver for job losses, people who with job losses, waiver of some fees like point of sale, relaxation in risk classification for affected customers, change in some regulatory limits like lending ratios to create more capacity in banking sector, and so forth. So a number of measures to help the banking sector and the economy and businesses. My question to you, Mohammed, was this enough? And if so, what timelines are needed for banks for all these relaxations?
Thank you, Mr. Ali, for your input. And it is a very valid question, actually, where we see the market, struggling. Central Bank was very close to, if we talk about Central Bank of Oman in particular, they were very close to all banks and the financial institutions. We feel that they have come with very sufficient, coverage at macro and micro level. Is it sufficient until now? I can see yes, because we are still during the crisis. Within the crisis, we are responsive to the development comes after, after every crisis, changes, especially, this crisis is, very, strange in kind, like, it is nature, affecting. There is no expectation where is it going to end and when, because it depends on a lot of factors and elements. Sectors are now coming back to business. I think mostly around 80% of the sectors are now active. We hopefully see, full-fledged economy recovery. We see that Central Bank has covered macro and micro level. Macro level, where they see the banking sector is receptive of all, shocks, observed locally or internationally. If we talk about the capital buffer, if we talk about liquidity instruments, so they can at that level, at macro level, support banks to be able and capable just to observe these shocks at their level, at micro level, where they see, deferments is coming. And by default, all DPDs, days past dues, will occur. So here, the IFRS 9 calculation should, waive such calculation, because initially it is encountered there within the system. So if it is calculated now and it is presented outside, they will show that the impact on banks' financials is huge. But if it is, I can say that it is win-to-win situation, where we see the client is giving a relief. Also, banks is giving a relief, where they feel that until those clients are recovered full, they are going to repay normally to banks. So banks will start again representing their financials as normal. And I feel so far, I think the Central Bank of Oman has come with sufficient inclusions, financial, non-financial, at governance level, risk management. Risk management here, the operational, the credit, and the liquidity, and also about cyber securities, including also the money laundering aspects of it, as we are expecting FATF to come next year. So they are working in parallel to overcome the crisis, along to be ready for FATF assessment. So thanks to central bank officials attending here or not attending, they are working hard, close with us, and we are involved in the initiatives brought up by central bank, along with the Oman Banks Association.
Thank you very much, Mohammed, for your candor approach and answer. I couldn't agree with you more. The Central Bank of Oman has been supportive very much, as well as the other regulator for the publicly listed banks, which is the Capital Markets Authority, have been, and the government in general, have been really supportive of the private sector, the economy of Oman, and the banking sector, to really show resilience to the adverse effects that have taken place, and to be geared up for the upcoming period. So thank you very much. We can open now the floor for questions.
There is a question from Dr. Kamis. Dr. Kamis, can you please explain your questions to the audience? Dr. Kamis, I will call the names, please come. So Dr. Kamis, can you Hello, there is a question from Dr. Kamis.
Yes.
Yeah, please. Can you please?
At first, I would like to thank all the distinguished speakers. I would like to thank the Oman Banking Association and also the CBFS for this excellent webinar. It's really very, very useful. I have posted my question, and I would focus, I make it very, very brief. Are there any unique features? I hear a lot of sounds.
May I please request from everyone to mute themselves? Thank you.
Yes, my question is, are there any unique...
Dr. Yahya, we cannot hear you. If you can unmute yourself, please.
Dr. Kamis, can you please unmute and speak?
Do you hear me?
Yes, we can.
Yeah.
Thank you very much. Thank you. I thought that I was unmuted. Anyway, I would like to thank the Oman Banks Association, the distinguished panelists, thank the College of Banking and Financial Studies. It's really a very thoughtful, excellent webinar, very useful to all of us. My question is very brief. Does Oman has any unique features that can make the recovery faster? Do we have any special features here in Oman that can help us to make the recovery faster? Thank you very much.
Any of the panelists can take this question, please. Any volunteers?
Carla here. I think I'll volunteer. My thoughts specifically on Oman and its ability to emerge from this crisis and the particularities or idiosyncrasies that Oman has to emerge from this crisis pertain to its position in terms of trade. So the main trading partner of Oman is China. And although the impact of COVID on China has been quite severe, we're not expecting China to have negative growth or a contraction in 2020. And its recovery is one of the few markets in the world where we do expect a V-shaped recovery. So with regards to its exports of oil, that is one area where perhaps Oman can recover faster than other oil exporters because of this particularity. The second part, this is on the external sector. On the domestic sector, the second particularity is that compared to other markets or other peers to Oman, where there is some level of excess capacity already in sectors such as trade or tourism or even real estate, Oman doesn't have this issue, and investment in diversification efforts away from oil and hydrocarbons into these sectors had been underway even before 2014, the 2014 oil price shock. So that investment, whether it's public or whether it's even private investment or foreign investment coming from China, will continue to underpin the fact that domestic consumption can also be quite strong and recover quite quickly. So these are from my side, my thoughts on the question.
Just a few.
Maybe, sorry.
Actually, just to add one thing here, we can see here from as bankers, we have seen that diversifying of also revenue lines in Oman, especially non-oils related revenues, is increasing during this period. Before the crisis and now during the crisis also. And banks are, very, supportive, and they are going towards that line, where it is also, a promising line of, business to the country. So I think yes, as Claire or Carla has mentioned that we are dependent on other markets like China and other markets where are depending on us. So their recovery is, helping us when they recover soon. Plus to that is the other lines when we talk about diversifying of our revenue.
And finally, just to maybe add a softer view on this, in terms of don't underestimate the talented workforce and young workforce that we do have coming through here in Oman. I think there is a lot of energy and enthusiasm, and I think confidence is very important in terms of moving forward through the crisis. And clearly the government with its initiatives continues to show initiative in terms of addressing the country's needs. So I think that combination of continued government support, recognizing where it's needed, I think with the workforce, the talented workforce that Oman does have, I think that would all play a role moving forward, if not in immediately short term, but certainly in the medium term to support the growth of the economy.
Thank you very much for the excellent answer.
Thank you. Dr. Hassan, you have raised your hand. Can you please unmute and tell your question?
Are you hearing me?
Yes, very much.
Yeah, it's me, Dr. Hassan, Assistant Professor in Digital Marketing and Innovation at Buraymi University College. Thank you very much for this wonderful meeting and gathering. I have two questions. The first question, as educators, as academics, we have learned a lot from this pandemic, and we have changed our business model into what's called e-learning and what's called merged learning with the traditional learning. As bankers, what you have learned, and are you going to change the business model as a reflection to this pandemic? This is my first question. The second question, are we optimistic or pessimistic in the future? In other words, every time we are having recession or a crisis, we are blaming someone. When will be the time not to blame anyone, and we will say we are ready and we will not be a shock? Thank you very much.
Just
okay. I'll start on that one. Thank you, sir, for your questions. Certainly, in terms of e-learning, the digital transformation, this has been happening in the banks in Oman, and I believe will continue to accelerate. We have to transform digitally. From a cost perspective, we need to do that. It's demanded by our customer base. We're all looking to improve the customer experience, make the products better for the customer, cheaper for the customer, quicker to market for the customer. E-learning, we embrace e-learning across the organizations. It is absolutely the direction banks are heading, not just for our staff, but for our customers and for those who are a part of our ecosystem. On your second comment about optimistic, pessimistic, look, I mean, I talked earlier about the importance of all participants working together. You can't underestimate the importance of team. Team is everything. And how we respond to the pandemic and the economic outcomes of that requires all participants to work together to achieve the desired outcome. It's not easy, but without the participation of all the regulators, the banks, the government, the supporting the auditors, whatever, we need to work together to achieve the desired outcome. So I'm always optimistic, because if I look through my banking career, 25, 30 years, I've been through a number of crises, both at a bank level and at market level and globally. And we always come out of it. It's about how you come out of it, how quickly, and how resilient are you to learning from the events, and how you make your bank and your country stronger in terms of how you respond.
If you allow me, actually, I want just to share a thought here. This crisis has given us an opportunity to learn, and it has also forced the public and the external party to use the digital platforms provided by banks. I can say that banks are ready to provide services through digital, but the other way around, the customers' experience should be also, receptive. Where we see now during the crisis, immense dependent on digital channels. We have mobile banking, internet banking, e-wallets, and we feel that after the crisis we will face and we will see a new era of banking through digital channels. And hopefully our society has now emerged, and we see that they have learned to use faster ways to do banking. Second thing about recovery and the looking forward, I think that we are still with during the crisis, and banks, if we saw last figures announced by banks, it is not promising. We have seen provisions booked by mostly all the banks, and which eroded the earnings. And we feel that December results, March results will be impacted. So I think it needs time until we recover. I think 2021 it needs at least whole year just to recover for financial sector.
Thank you.
Thank you very much.
Yeah.
That means we have to be patient. Thank you for this excellent and diplomat answer. Thank you for all.
Then we'll take one or two questions. I think the time is behind us. So there is one question to Mr. Mohammed from Mr. Dr. Anil Kumar. He has asked a question. Do you see any challenges exclusively different from commercial banks during this pandemic? This is the question to Mr. Mohammed.
Yeah, that is a very smart question actually. Islamic banks actually are financing, financing assets-based or assets-related financings to clients divided to individuals and corporate. So we see there are risks associated. In terms of risk-weighted assets, when we compute our capital, and in terms of capital and provisioning as well. So if the securities are reduced, we have to increase our provisioning. We have to exclude some securities from the calculation. Where we face that, it is like, a challenge to Islamic banks. Having cop-up financials with the conventional banks. One more thing is very important: the liquidity instruments provided by central bank to Islamic is very limited, where we cannot enjoy the same liquidity instruments by as enjoyed by conventional banks like repo. We don't have Islamic treasury bills. We don't have Islamic CDs. So we are facing a difficulty where we secure the funds to fund our assets. Thanks also to Central Bank of Oman, they are working on liquidity instruments, and hopefully they come out soon, inshallah.
Thank you. We are we exceeded the time, so hence I can take only last question. That is Dr. Mavia Ahmad Hussain. Can you please explain your question quickly? This will be the last question. Then Mr. Ali will make
okay.
it.
Okay, thank you, Dr. Anand, and thank you for the presenter for this valuable presentation. What we learn mostly from this pandemic, we have to stay at home. This is the only slogan that is raised by every body, by every government, by every. So given that, we have to change our business model. So for banks, they have to go to e-transactions. For e-transaction, in this case, the banks have to invest. And because we have peripheral areas, we have many people, they can't use these e-transactions. So what banks can do for this, learn people how to use these transactions and how to trust, because there is a problem of security. Okay, and as it mentioned by Mr. Mohammed Hamid. Okay, so this is just my questions.
Actually, we faced a lot of challenges, especially during the crisis. That we had plenty of users on our digital channels, and it was to us, honestly talking here, a challenge. Plus, it is opportunity to upgrade our systems and lines to be ready for observing the load coming from our customers. Now we have seen all banks are doing excellent. They are providing all digital channels to all customers, and we feel that in 5 years time or 10 years time, I think there will be a shrink in physical existence of banks, and all will be only digital. And the cashless also will be promoted well in 5 years time in Oman, inshallah. And I feel that banks are ready now. And our society is receptive. They are, accepting the risk. Now, if we talk about the cybersecurity, we have been, I'm aware, in banks, we have been instructed clearly by Central Bank of Oman to have the proper governance, maker and checkers, and we have to have proper information security systems in place, where we safeguard our customers' data and safeguard our financial lines from external threats.
Maybe just
sorry, go ahead.
Just to,
yeah,
sure. I'm sorry, just very briefly. I think there was a second part to that question, if I heard it correctly, and that was about inclusiveness. This remains important because it's okay for those who are very savvy in terms of utilizing e-technology, have their smartphones, but banks are still conscious that there is an element of the population who need to be included within the banking system. Hence, we still have branches. I think you'll see maybe a change in the size of branches. There may be opportunities for expanding, mobile banking to be able to provide services to the customer. COVID-19 certainly is a challenge because we're trying to move away from direct contact, but banks are very conscious of ensuring that we provide inclusive services to the population of Oman.
Thank you very much. If I may, I also have some comments on this very important question. Oman's demographics are unique compared to some other GCC countries. The mobile penetration in Oman is fairly high compared to many other countries. The network coverage in Oman is also high compared to many developing countries or countries in the region. We've seen over the last, not necessarily during COVID, but specifically during COVID, the number of subscription of e-channels have dramatically increased in the banking sector. And much of that percentage growth is actually from rural areas. So it is actually the population, which is relatively young, with mobile connectivity and coverage, are actually shifting towards e-services and e-channels. And this has been the trend over the last, or recently, over the last couple of years, but specifically during this year. So there is that paradigm shift, if you like, to e-channels, and that is happening as we speak. So hopefully I answered your question. Thank you very much to all. I'm sorry that we are running out of time. Thank you to the speakers, all of you, to the ones who have given their questions, very to Central Bank of Oman, and over to you, and to the College of Banking and Financial Studies. Over to you, Marwa. Thank you.
Thank you. Thank you very much, Mr. Ali, and thank you, key speakers. With that, Dr. Anand, would you like to conclude with a few words before we end the session?
Yeah, thank you. Good afternoon to you all. Before we say goodbye, it's our responsibility, it's our obligation to say thank you for all those who have made this session successful. This is a Oman knowledge sharing series we have just initiated during this pandemic. Basically, the objective of this series is just to share the knowledge across the globe. So under this series, we have a plan to come out with various webinar series in the near future. This is the second one we have already done. We are going to have a discussion on research-related topics as well as management practice topic. The previous one was research-related topic, and this is the management practice topic. So this series will be continued in CBI under the aegis of CBFS as a part of knowledge transfer initiative under research. And for this webinar, I'm really glad to inform you that we have received around 780, close to 800 registration from 25 different countries. This is in real sense, this is a real international webinar in real sense, a true sense. And in this today's live webinar, I'm happy to see that around 290 people participated during this session. And some of the people, they have unable to attend this. That is why there are no need to worry for that. We have already recorded this webinar, and we are going to upload under the CBFS YouTube channel so that you can download or see at any time you want. So once it is uploaded in CBFS YouTube link, I will share it the link to you all, to all the registered delegates, so that they can see it in the future at their convenient time. And then in this pandemic time, in this competitive world, it's always everybody's responsibility to upgrade their knowledge base as well as improve their competency level. I certainly hope this webinar has given a very good scope for all the participants to enhance their knowledge base as well as improve their competency base. And before I conclude, I take this opportunity to say thank you very much to Ms. Carla, Mr. Craig Bell, as well as Mr. Mohammed Hashimi for sharing their wonderful thoughts and scholarly views on economy, banking, as well as education sector. So we appreciate your contribution. We thank your contribution for today's webinar. Because of your thought sharing, knowledge sharing, our today's webinar is highly successful. And any seminar or webinar will not be successful without the participants. So I really thank on behalf of OBA as well as on behalf of CBFS, thank both key speakers as well as all the participants who made this webinar very live and active. And I also thank our co-organizer, Oman Banks Association, as well as I also thank our CBFS management for supporting this event. And I also thank all my colleagues who have helped me for this webinar successful. And finally, I have already uploaded feedback link. You please, all the delegates, I request you please fill this feedback link so that it will help us to improve or help us to make better program in the near future. With these few words, I say goodbye. I say thank you all. Thank you very much for your active participation as well as contribution. Thank you one and all. So
thank you, Dr.
This we end the conclusion. Yeah, please go ahead.
Please go ahead if you're done.
Yeah, it's over. It's over. Please go ahead.
Okay, thank you. Thank you everyone for joining us today. And yeah, we hope to see you soon again next time. Thank you. Bye.
Thank you very much. Bye-bye. Thank you.